we've been crunching the numbers here at Capital Economics. If you just look at the 3-day moves in the equity market, there's only really 2 or 3 circumstances in the last 100 years where we've seen equity market falls on this scale. So in the equity market, things feel like a bit of a bloodbath. I take your point about not using hyperbole, but it does feel pretty grim in the equity market. I think if you're looking for some comfort, things have not got quite so
Right.
grim in credit market. And if you look at the cross-currency basis swaps, which is perhaps the best indication of stresses and strains in international funding markets, they're getting worse, but they're not really at dire levels yet.
Out of 1998, do you detect, and does your great team at Capital Economics detect contagion here? Paul Sweeney and I went back and forth as Duke was losing, but he was medicated, folks. And the basic idea, Neil, what I'm hearing in the zeitgeist this morning is watch private equity, watch private credit. Does Capital Economics see contagion this morning?
We're seeing some signs of credit markets starting to crack, but it's nowhere near as great as we're seeing in the equity market. So I think at the moment, this is primarily an equity market drawdown. We're not seeing the same level of contagion or sell-off in the credit market at the moment. And as I say, in those international funding markets, if you look at cross-currency basis swaps, for example, they're not pointed to the same degree of contagion or really severe strains in funding markets yet either. Could get there, of course, but we're not there yet.
Neil, there's concern building here in the U.S. about a recession. How do you think about the broader economic impacts of these tariffs as they're currently configured?
Well, how long you got?
Yep.
Because this is one of those situations where economists will give you a single number and it's almost entirely meaningless because there's so much that depends that goes into to determining the economic effects of tariffs. You've got to think about, do other countries retaliate? For the US, you've got to think about, does the administration spend the revenue that it receives or cut taxes in other ways? You've got to think about the so-called import elasticities of demand, price elasticities of demand for imports. How much might they fall in response? The dollar, that's the big question here. The dollar's supposed to strengthen, of course, after the imposition of tariffs. That's what we had in 2018. It's not what we've got now. So anyone giving you a really precise estimate of what's going to happen to US GDP or any other country's GDP for that matter in the wake of these tariffs is being disingenuous. Much better, I think, to think in terms of scenarios. Now, if these tariffs stay in place, it's going to knock somewhere between, I think, 0.7, 0.8, 0.9% off of Chinese GDP, maybe 0.3, 0.4, 0.5 off of the Eurozone. And in the US, it's going to be a pretty big hit there, maybe 0.6 to 0.7 relative to a pre-tariff baseline off GDP. Then, of course, the question is, do they get negotiated lower? And that's the big unknown.
Neil, how do you think central banks, what role can they play here in a world where it seems like a trade war is in the offing here?
Well, not a great deal. This is a trade war created by governments, primarily the US government. And I think it's still a US trade war rather than a global trade war.
Sure,
but there's not a great deal that central banks can do, I think. Right? What they can do is they can ensure the market plumbing continues to function, and that's what they will do. But the Fed in particular is going to be in a real bind. If these tariffs stay in place, then it looks on our models like US inflation heading over 5%. Now, is the Fed going to feel comfortable cutting rates with inflation shooting over 5%?
Well, and the president just out with a tweet, folks. I don't have it in front of me, but basically he said, quote unquote, all caps, there's no inflation. He also bet on Duke, so who knows where that's going. Exactly. Neil, one final question. What's your x-axis this morning? How much time do smart people have to advise the president to pull back from the cliff? Is Capital Economics looking at hours, days? Is it weeks? Is it deep into the summer?
It's going to really, I think now in the very short term, it all depends upon what happens in financial markets and in particular in those credit markets. If that starts to crack and we start to see contagion spread through the financial system, then the administration is going to have to act quickly. If it doesn't, and markets kind of muddle through and the equity market's down, but the credit market, fixed income market, currency markets hold together, financial plumbing remains kind of liquid, if you like, then we may have a few weeks and months, but we can't wait to kind of Q3 for any kind of certainty here. This needs to we need some kind of certainty and some reversal.
You writing for the FT today? Do we see Neil Shearing tonight in the FT?
I'll be everywhere, Tom, as usual.
Is everywhere. Neil Shearing, thank you so much.
Whoever will have me.
We start strong out of London with Neil Shearing, Capital Economics. We went out, folks, with the surveillance Rolodex, and we said, who bet against Duke? It has to be Damian Sassower joining us right now. Forget about basketball. This is too serious. What's a contagion on the Pacific Rim? I mean, right now, Vietnam, this shirt I'm wearing, folks, is some 60 miles northwest of Hanoi. I won't bore you with the details, but the answer is the tariffs are already clicking in. What's the fragility you see?
Well, Tom, when we left on Friday, we were questioning at what point does a flight to quality trigger a stronger dollar? And lo and behold, Monday morning, here we get our answer, because currencies across the board are basically rolling over relative to the dollar. You see that finally, perhaps the dollar smile is coming back into play. Recession risk now at 60%. If you look at markets, it's really been driven by break-evens, Tom. It's been driven by inflation here in the U.S. They're finally falling. They've been sticky to the high side for a while. This recent move since April 2nd, the move in U.S. yields, a lot of it driven by declining inflation expectations. Again, the recession risk is now in play.
But there's inflation out there now. How does it fall away based on your study of Ecuador, Argentina, and every other Sassower-led crisis?
You can't even look to those markets without dusting off the impact, the pass-through from U.S. rates to the U.S. dollar into funding markets basically globally, right? So who are the biggest funders in dollars? You're talking Europe, you're talking Japan, you're talking Great Britain. You look at cross-currency basis spreads. Again, Paul Sweeney knows this. You dust off the recession playbook. You're looking at cross-currency basis again. You're looking at two-year swap spreads. They're barking right now. They've narrowed to negative 22 bips. It's like a crazy move in 2 days, 3 days. And so now what you're looking at is just under the kimono, who's got strong hands and who doesn't.
Excuse me, we can't say that on radio.
I'm sorry.
John, is that appropriate?
The PBOC is under the... China's under the kimono. They have set their fixing less than 720. That's the first time in a long, long time. That's like the red line, the soft red line that traders look for. It means that they're going to allow the yuan to depreciate relative to the dollar, and that means weaker Asian currencies across the board off the back of that. So, yeah, we're looking for currency weakness relative to the dollar here in the near term.
So are the emerging markets, are they pricing in a U.S. recession, do you think?
So it's interesting. You have to look to credit spreads, right? Because obviously that's where things blow up. That's where the illiquid stuff, right?
Yep.
I guess credit. So you have to look at where spreads are going, and they hadn't really budged for the better part of this move until last week. And now you see China 5-year CDS up 50% to 78 basis points. So the cost to protect against your China holdings has just basically gone up 50%. In Europe, 30% move. The crossover index, the Euro CDS.
So
these are proxies for credit spreads for the health of the European and the Chinese.
So the insurance against that is going up dramatically, suggesting that traders are concerned about global slowdown/recession.
About getting paid back on the money they've lent them, on the dollars.
But every single emerging market animal is telling us, Damian Sassower, that this is not 1998. The balance sheets are better. The mixture of their currency and dollar-denominated debt is better.
Yes.
Is it?
Well, yes, it is. And actually, that's what makes this one a little bit different for me, Tom, because, in years past, when you have a risk-off move, it's because you have this over-leverage. People have gotten caught overexposed to emerging markets.
Good morning, Myron Scholes.
Well, high beta asset class. Emerging markets have always been a high beta asset class, but they failed to participate in the move in U.S. equities of the last 3 years. So positioning has been notoriously light compared to other drawdowns that we've seen. So you're saying,
I got to get to something else here, but Damien, you're saying it's not 1998.
It's a little bit different. Every sell-off like this is nuanced, but this one is a little bit different for me. And I think now finally we're seeing a bit of capitulation here in the dollar. You have to watch and see.
Damian Sassower, and we'll continue with them. The VIX up near 50 now, 47.05, still uncomfortable. Sweeney paying attention at level 30. Dow, the Dow negative 500. It was well over negative 1,000 3-4 hours ago. We have a better tape all in all as we stagger to the morning. The president tweeting out. We'll get those comments to you in a moment. Bitcoin, 77,000.
Yeah, saw that.
Really something pulling back here. Finally, the 10-year real yield. I have a quote, and this is critical. It really hasn't moved this morning. James Dimon with 58 pages. It's all the financial stuff and the usual thing. I love what he says on page 41, Damian Sassower. We're not in Kansas anymore. Economy, inflation, interest rates, asset prices, trade wars, oh my. How should our listeners, our viewers on YouTube, how do they filter the China-U.S. relationship from the incredible set of litmus paper you have?
It's just about the fixings. You know, the PBOC
What
every
does that
morning.
mean?
Okay,
Jargon.
so China will set its currency. It manages its currency, Tom. As you know, there's a 2% band around the China yuan that it can move each and every day before you know, the government basically closes it down. Circuit breakers go up. And so, you know, what they do is they set that fixing every day. China yuan is trading at 731, 732 now, but they just crossed that red line on 720. If they're going to start allowing the fixings to gradually move higher, that tells me everything I need to know about, you know, currency risk.
I totally agree. Let me translate that. There's a famous theory, Mundell, Peggy Fleming. It has to do with foreign exchange. They're going to solve this by managing. Stay with us, John. Tucker's been up all night, folks. Stay with us. Okay, we'll have the opening of the 101K envelope in a bit. Damon Sassower. Critical. Their solution, like every solution back to the Bible, is to force a depreciation.
Tom, we follow the dollars. We're card counters here at Bloomberg Intelligence. Paul Sweeney knows this. And so what we like to do basically is find out, I mean, I don't want to talk about the tariffs and the impact, but, you know, if I'm sitting there and I'm in Indonesia or I'm in the Philippines or I'm in China, I'm basically saying, okay, I'm taxed at this. This is my new tariff to the U.S. Where can I dump my stuff and get a better rate? You know, this is just about a rerouting of trade, about substitution effects. And so it's going to take time to work its way through. But I think the markets are looking through this and saying, you know, this is going to change things. It's a tax on the U.S. consumer. It's a tax on U.S. corporates. But inflation is actually going to come off in the rest of the world. Inflation is going to remain high. And that's a huge difference.
Maurice Obstfeld nailed this weekend.
So real yield differentials with the U.S. and the rest of the world are going in a different direction for the first time in a long time. You know, I mean, real yields are kind of rising in Europe and Asia relative to the U.S. where they're declining. That's a different paradigm than we are used to here. So whether inflation stays high in the U.S. and it doesn't spill over the rest of the world,